Hello and welcome to another episode of the Deal Flow Show. I'm JP Maroney, your host, along with my partner in crime here, Mr. Paul Nicolini. And we're excited. We've got a guest on the show that I believe our team first connected with in LinkedIn. Isn't that right? And
Yes.
We found out a little bit about what you guys were doing and thought that it was really good that y'all could come on the Deal Flow Show, share from your storehouse of knowledge some of the things that you've learned, Jack, over the years, as well as to be able to talk about some of the deals that y'all might be working on, how you put things together, your due diligence process, understanding that we're both going to talk about the opportunities that you're involved in now and share of your knowledge, and the information that we're using or giving in this show will also be part of a new book that we have coming out called Deal Makers, Deal Breakers. So excited to be able to tap into the years of experience that you have and put this together. So we have Jack Ablin on the show from Cresset Capital. And I'm going to let you lead off this time and you ask all the big questions.
Well, we can start with the loaded one. How'd you get started in the business?
Well, Paul, I got started in the business in 1982. I was a math and computer major and learned that the mutual fund companies in Boston, the Putnam, Scudder's, I ended up at Keystone, would not only pay for your business school, but they buy you your books and everything. So I started at Keystone as a quantitative analyst. You know, my job at the time was to help analysts and portfolio managers take those green ledger sheets they had with their cash flow models and transition them onto spreadsheets. Those days it was VisitCalc and Lotus 123. Now that's how I got started in the investment business.
Lotus 123. I haven't heard those.
Somebody,
yeah,
right?
I haven't heard those terms in a while. Talk a little bit about the work that y'all do today at Cresset Capital. What sort of deals you're working on?
Sure. So, our clientele is primarily entrepreneurs, business owners, first generation wealth, typically have either engaged, in their business and have potentially sold their business, maybe sold a piece of their business, and then have now moved from managing a privately held, closely held business to now managing capital, which is a very different experience. As you know from entrepreneurs, they're generally control freaks. They believe that they have a sense of their own destiny. They can always make tactical changes to the business to accommodate whatever challenges lie ahead. And then once they end up with just a pool of capital, they feel completely helpless. So our job is really to take that capital and to harness it in a very similar way than they see their business. And what we do is we just start by building their own customized defined benefit program. They say, first question is, what do you need from this portfolio every year for the next 40 years? And let's allocate that. Let's dedicate assets to that. And then we've got money left over to do longer dated stuff. Our team, there are 4 original partners. 2 of our partners are private equity professionals, and myself and another partner came from the private banking and investment world.
Well, I would have to agree with you that AKA we entrepreneurs after 30 years of building companies are control freaks. So you got it. Absolutely. Quick question. So we have a lot of folks that watch the Deal Flow Show, listen to the Deal Flow Show, that are at different phases of their businesses. And certainly many of them will be either coming up on or right in the middle of an exit, as you were talking about, where now they've got capital, pool of capital. What are some of the things that they should be thinking about as they're putting together a deal team for the next phase of their business career, or more going into the allocation process as opposed to operating company?
Sure. I mean, we tend, because we come from a history of entrepreneurship and we have a whole ecosystem of business owners, we can offer a variety of advice, not just who are the best bankers to use in their particular business, perhaps how to structure a deal, maybe also structure the entity in which the deal is held and then subsequently sold. Perhaps if you want to get, create a succession plan to get the next generation involved in the business. So we have a lot of experience with that. And then what your domicile is. I mean, do you really want to sell your business in California, only to find out that, you owe the state, an additional 13%, or would you, potentially relocate to Nevada, Texas, Florida, somewhere else where perhaps the tax burden is a little bit less. So those are the kinds of things we try to, capture pre-deal, pre-close, and then of course helping manage liquidity once it comes in.
In the best of all worlds, how early are you coming into the process pre-exit?
Yeah, we, just because we are engaged with a number of bankers, they tend to bring us in because they have an interest in making sure that not only is the deal successful, but their clients are achieve what they hope to achieve, and on an after-tax basis get what they're hoping to achieve. So we really look at it from a tax perspective, a family governance perspective, and of course financial planning perspective as well. So we often get invited early on, and then we also come in after the deal has been closed as well. So just different variations.
That's great. Cresset started in 2017, I think we said on a previous call, and now you've got over 8 offices. That's pretty impressive growth. Can you explain how that transition is from startup to now?
Yeah. So we've just surpassed the $11 billion mark, and out of that 11 billion, 3 billion of it is acquired. So we've made 3 acquisitions, 2 relatively small ones, 2 $500 million assets under management businesses, and then 1 $2 billion assets under management business earlier this year. But really, the rest is, 9 billion is organic, and it's certainly impressive growth over the last 2.5, 3 years. And we're on track to bring in another billion of assets organically this year. So I think what we're doing is, we've got a compelling story. We are now among the top 25 largest RIAs in the country. We're the largest RIA in Illinois, and we're now competing head-to-head with the bulge bracket banks, where we have a lot more flexibility and access to private investments, direct private investments, not fund to funds and too far away removed from the actual investment itself.
That's a good lead into the question that I was going to ask you about allocations. When we come back, we'll talk about that. If you're watching or listening to this episode of the Deal Flow Show, you can get access to our previous episodes, our archives, and also subscribe and follow us for future episodes at thedealflowshow.com. That's thedealflowshow.com. Again, Jack Ablin here from Cresset Capital. So you were talking about the amount of, number one, kudos for that much in assets under management since 2017. Further proof of what I keep saying, there's money running in the streets. You just got to figure out where to put your bucket. And a lot of people, they just don't know where to put the bucket. So you guys have done an excellent job of attracting assets. What are y'all typically allocating to? What are y'all getting involved in? What kind of deal opportunities excite you today?
Sure. So on the private side?
Let's talk about both, but let's start with private.
Yeah. So, because we're running a goals-based investing strategy, in other words, we drive the desired cash flows for our clients, we have 3 primary strategies that we employ. Our first strategy we call diversified income is designed to deliver cash flows from overnight to 7 years. Our growth strategy is designed to deliver cash flows from 7 to 15 years, and then our aspirational strategy designed to deliver cash flows 15 years and beyond. Generally, we try to lock in our clients' lifestyle, so to speak, with the first 2, with diversified income and growth, and then that leaves aspirational with what we call wealth surplus. So multi-generational, perhaps impact, charitable, and whatever kind of desire and goal that family has for what we'll call the next generation or beyond the 15-year time horizon. What we look at is in our diversified income strategy, we're looking for income from a variety of sources. Obviously, on the public market sides, it's pretty limited. We're looking at, pretty much bonds and preferred stock and things like that. On the private side, we have a lot more flexibility. So we have a private credit vehicle where we're looking at things like litigation finance, life insurance settlements, music royalties, just trying to generate income from a variety of sources that don't seem to be correlated with one another. We're also looking to launch a real estate income fund, again, for the diversified income strategy, where we could be doing, we would be doing maybe some bridge financing and some other shorter term equity holdings for high quality real estate. So that's what we're doing in the diversified income strategy. In our growth strategy, designed 7 to 15 years, we have our own private equity secondaries vehicle called Flowstone. So we're in the market buying limited partnerships in the secondary market and delivering those through a registered interval fund. And then we do direct deals. We have a relationship with West Monroe Capital, West Monroe, the consulting company, and we have a partnership called West Monroe Capital, where we're finding original deal flow and doing direct deals that way. So we generally don't buy funds or fund of funds. We're looking for direct investment in private opportunities.
What's the check size typically, if you don't mind sharing?
So minimums for our clients, we can do pieces as small as 100,000, and we do it on a preferred fee basis because they're advisory clients. But I will say that we also offer our vehicles to outside clients as well and other family offices. I should also mention we launched one of the first qualified opportunity zone funds back in late 2018 when legislation was first rolled out. We raised $480 million in that fund and closed it, and now we're going to look at starting fund. We're gathering assets for fund 2.
Are y'all doing anything with SPACs?
We are considering it. We haven't done anything with SPACs, but it is a possibility because of our track record and history in private equity. We are considering perhaps raising a SPAC, but we haven't launched anything.
I would think it would be an interesting dynamic where y'all have obviously the capital, but you also have a pool of experienced operators that have exited, where you could build a pretty incredible leadership team and or board for a SPAC and be able to go and do something pretty extraordinary in the market. That just seems like a natural.
Yeah, I mean, we have just a really fantastic advisory board, leaders of companies from a variety of industries, and it's fascinating. We actually did our shareholder meeting last week and an advisory board meeting, and it was a fun conversation. It was pretty much an all-day meeting, but it was really engaging.
I think it'd be interesting, and I don't know if I know y'all have video capabilities because you had a guy helping there in the beginning. Have y'all tapped into the knowledge of all of this breadth of experience and captured it in any kind of educational pieces?
We haven't. We have done webcasts and links for our clients. In fact, I was just on one that we try to do every other week. This one was more market oriented. But we can also get other parts of our leadership team. For example, for some reason we have a whole cadre of former auto dealers. These are families that have owned franchises of auto dealerships throughout the country, and have maybe just because they know each other, they've come on board. So we have a whole. So if we're looking for anything in auto or auto retail, we have a huge wealth of information and knowledge just on our advisory board.
That's exciting. I love the ability to be able to tap into a brain trust like that. It's always made sense to me, as Harbor City has talked about the next phase and where we grow in terms of acquisitions and private equity side, to be able to bring those leaders of those businesses together to cross-share and cross-pollinate the things that are working and the things that have historically worked in a diverse number of different industries. I just love the ability to transplant great strategies and ideas from one industry to another.
Good segue, because we were going to ask, what are some of your success drivers?
Yeah, I think a lot of it is a very strong culture. We know who we are and we know who we want to serve. So if you juxtapose, Cresset against, a bulge bracket private bank like a Northern Trust, a Bessemer, or, JP Morgan, let's say, think about it in terms of inherited wealth versus first generation originated wealth. And I think, while I'm not going to, sneeze at inherited wealth, we really don't cater to that, kind of client, partially because we like that hands-on impact that our clients have. In fact, I should mention that 30% of our company is owned by our clients. The other 70% is owned by employees. So not only do our clients get really excited, or prospects get really excited about participating in what we're doing, but they actually want to buy in, and we allow them to do that.
That's great. Jack, you're a prognosticator as well. I've seen you on CNBC. I'm sure most of our audience probably has too. Tell us about what you see in the capital markets today, and more importantly, I guess, going forward, being that we're dragged through the mud here with COVID and the election year. What do you see in the short-term future of the markets?
Sure. So, one of the things I noticed with this tech downturn is a recognition that perhaps investors are starting to see light at the end of the tunnel. There's actually good news. I'll ask you guys, and I'm sure you know the answer. What's done better over the last 6 months, Amazon or Royal Caribbean Cruise Lines?
Royal Caribbean for $500.
Yeah. Royal Caribbean is almost doubled the return of Amazon since the middle of March. And in fact, a lot of that boost was since the end of July. And so, when investors are jumping on Royal Caribbean and moving away from Amazon, what that suggests to me is perhaps they're starting to see that light at the end of the tunnel, that maybe this vaccine is around the corner, that life will eventually get back to normal, and that companies like Royal Caribbean and others have, thanks to the Fed, have been able to raise debt and sustain themselves through this drought, and will come out the other side not only alive, but probably pretty well positioned. So I view that as a rotation. I think because these, the big five tech companies do represent 25% of the S&P 500, it will look like a pullback, but it will actually be a broadening of a lot of the out-of-the-way names that have not participated. In fact, year-to-date, half the S&P 500 is either at zero or in negative territory year-to-date. So I view it as a broadening, but we will see some choppiness around the election. We will see some uncertainty. Some of our clients want hedges of their portfolio out to December. I can't blame them. I'm kind of agnostic, but we can put option hedges. We don't buy structured notes. We actually put the exchange traded options in place to do essentially the same thing without having to rely on a Deutsche Bank as a counterparty.
You talked about in the beginning your background, or the beginning of your training as in quantitative analysis. I want to come back and piggyback off of that in just a moment. But if you're watching or listening to this episode of the Deal Flow Show, you can get access to our previous episodes as well as get access to our future episodes by following and subscribing to us at thedealflowshow.com, thedealflowshow.com. We've got Jack Ablin obviously on this episode from Cresset Capital. So you started from, as an entrepreneur, I'm a gunslinger, right? So raised in a completely different environment. The environment you came up in, very numbers driven, analysis and process and all of that. What is your process or analysis when y'all look at a fresh deal? How do you approach it? What are some of the steps that you walk through in that due diligence or evaluation process?
Sure. Really what we want to do is look at it with the client in mind. So, most of our clients are looking not to hit a grand slam or even a home run. I think they're looking for current income. They're looking for stability. They're looking for predictability. So for us, we like middle market cash flowing deals. We'll also we did take a minority position in the company using convertible preferred. So, we're willing to give up that, 25 to 30% IRR in exchange for, 12 to 16% IRR with a stable, predictable cash flow. So for that, for us, that's a home run. We're also right now not in too much of the venture capital business. Not to say we'll never get there, but again, we're really looking for middle market, stable operating businesses and real estate. Middle of the fairway stuff and we take on low leverage. So from that perspective, that's kind of what we're looking for. On our qualified opportunity zone, we've partnered with Larry Levy and Diversified, who, by the way, is a client and an advisory board member, Ann Hines, top-notch developer, to build real trophy properties all over the country, mostly multifamily in opportunity zones. So those are the kinds of deals, kinds of plays, we're looking for. So it isn't to say we won't look at something opportunistic, but we're just not there yet.
Jack, tell us, with $11 billion under management, there's got to be undoubtedly a lot of ups and downs. How do you manage the downs?
Yeah, so a lot of it is really just, managing the market, managing expectations. So for example, our equity strategy is a 7-year minimum. So we've designed our equity portfolio to have a 90% success rate in making money over a 7-year holding period. And every quarter we look out 7 years based on our new capital market assumptions. And if we cannot assure ourselves of a 90% success rate because maybe valuation's too high, then we will actually take risk off the table. In fact, we did that in the fourth quarter of 2019. We couldn't get to that 90% success rate number and actually entered 2020 with 15 percentage points worth of cash. So that helped us in the March 31 when we reran it and got back to that number. So that's how we do it on the growth side. It's all long term, and you know how it works. I mean, if you buy the market today, you have maybe a 52, 53% chance of making money over a 1-day holding period, a 60-something% chance of 1 year, a 70% chance over 5 years, and roughly 85% over 7 years. In a diversified equity mix, it's over 90%. We do the same thing with our income strategy too. We want a 95% success rate in a positive return over a 3-year holding period, and we're willing to make those risk adjustments to make sure that happens. So it's all about delivering on the predictability, trying to harness predictability from what seems like an unpredictable market, especially as you said, as we've said, from these control freak entrepreneurs who want to know where every dollar is going and where it's coming from.
You gave some statistical information there. How much has that been affected, what you've probably been talking about for the last 20, 30 years with this statistical, how it might look in 24 hours or a day, versus a week or a month or a year? How much of that has changed over the last 3.5 years under the current administration, and how much of that has changed over the last, say, 5-6 months under COVID?
Yeah, so a lot has changed. I mean, I would say as of maybe 5 years ago that 90% success rate over 7 years could have just been achieved by the S&P 500 by itself. Between 5 years and last year, we had to diversify. We had to go to more of a, an ACWI, a total world portfolio, to be able to get that 90%. Last year, it fell below 90. ACWI fell below 90, so we had to now take risk off the table. As of March, it popped back up above 90. We were able to add. Guys, I think we could be looking at the end of this month in September, that same statistic, we may be prompted to take money off the table again. I haven't run the numbers yet because we haven't calculated it, but I suspect we will be taking some of our risk off the table in our growth strategy in September 30th. Yeah, with low interest rates, higher volatility, and expected returns that are closer to the basement than the ceiling, it's a harder and harder hurdle to achieve.
Does the election come into play as well?
No, because we're looking 7 years. It really doesn't.
Right.
The only way it would come into consideration is if, by September 30th, the market was a lot cheaper and everyone's worried. I will say, one of the other things I look at is investor sentiment. We track bulls and bears, and right now on a bullish and bearish continuum, we're in the 4th percentile, one of the bottom decile of its historical range, and that's generally bullish 1 year hence. When the market, when investors are so widespread bearish, their expectations are very low, and in a market where it's just the reality of or the combination of reality and expectations, much better to have low expectations than high expectations.
That's great. Jack, when you're working with other people on a deal, we know there's a lot of moving parts and so forth. What are some of the deal breakers for you?
Yeah, one of the things we do, which is a little bit different than a lot of other, private equity deal investors, is we look from the top down. So, what we want to do is figure out where a deal like that would fit, because we have certain parameters we're looking for. So, for example, if we're looking for income real estate in our diversified income strategy, one is we have to make sure we can get full circle back, or at least a fair market value within 7 years. Secondly, it has to pay current income, and thirdly, it has to possess a volatility, underlying volatility that's consistent with the risk parameters we have in that strategy. So, in many respects, that's where the deal breaker is going to be. It's just that the parameters don't fit. And the only other thing would be maybe too much leverage. We want to be able to ride through downturns. We're ready to hold forever. We don't buy a deal with an expectation of flipping it, over the next, 3 or 5 years. And that's really a huge difference from a lot of private equity fund investing, where, because of their economics, as soon as they acquire a deal, the shot clock starts. And the faster they can turn that thing around and flip it out, the better their deal economics are, even if it means sacrificing return for their limited partners. So for us, we want to own it the way a family would own a deal. We try to, what we're trying to do is create a family office environment, and we're bringing it downscale to clients of $10 million and even a little bit lower than that.
You wrote the Wall Street bestseller, Reading Minds and Markets. I want to talk a little bit about that in just a moment. But if you're watching or listening to this episode of the Deal Flow Show, you can get access to our previous episodes, archives, as well as subscribe or follow us for future episodes by going to thedealflowshow.com. We have Jack Ablin on from Cresset Capital. Jack, you wrote this book, and we're all told, or at least advisors are always telling people, don't try to time the market or maybe read the market or something. But you wrote a book that says how to read minds and markets. What does that mean?
Sure. So this was before I really latched onto goals-based investing. I was fascinated with this conundrum between the predictability, tranquility that investors want from their lifestyle, and yet it's funded by something so volatile and irrational and just obscured. And so I had really spent most of my career trying to harness the uncertainty to deliver predictable results. And so reading minds and markets was a way using macro risk adjustment to essentially take a 70-30 portfolio, but create the same downside risk as a 50-50 portfolio. And so I did that with a firm that I launched in mid-1990s, and then sold that to Harris Bank in 2000, and then came on board as their chief investment officer at Harris Bank BMO from 2001 to 2017. Before then, I latched on to this new goals-based investing that delivers really a combination of diversification and holding period to deliver those predictable results.
Have you found, this is kind of a sidebar question, but you wrote a book. You're obviously a recognized authority in the media. Have you found that the book opened doors or opportunities, led to opportunities that you may not have had otherwise? I heard a great quote the other day. I don't know if you've ever heard this quote, but it says, if you're not at the table, you're on the menu. And I think that my opinion is that a book, being an authority, can get you to certain deal tables that you may not have had access to before. How has that worked for you?
I think, no, I think what it's done is it's offered a little credibility that, I can put my, thinking down where my mouth is. So I think I've still had to get myself to the table, but I think having this book and also I was on the faculty, I was in the finance department at Boston University School of Management. So having an academic background gives me a little credibility once I'm at the table. But I'm not sure it's created opportunities where they wouldn't have existed without that.
Jack, we've had a lot of great guests like yourself on the show. What kind of people would you like to connect with from our audience and our viewers and also our guests?
Sure. I mean, I would say our ideal client is an entrepreneur, someone that understands business, appreciates what it takes to actually build a business and grow a private business, and the risks and all the sacrifices involved with that business, talk to us. I think you'll find that we're all, like I said, I've had started businesses myself, and I think that allowed me to really see the world through the eyes of many of our clients. So I would say reach out to us and connect, because we have a whole ecosystem of really brilliant entrepreneurs, and they're very excited about doing business.
What is the best way for someone to get in touch with you or Cresset? Is it the website, email, what?
Yeah, I would say I would suggest start with going to CressetCapital.com, and you can reach out to us through that website. If you'd like to send me an email, you're welcome to do that at Ablin, Jablin, at CressetCapital.com. But the website's great too. So either way would be fine.
Don't mean to catch you off guard, but we asked this to all our guests. Share with us something that otherwise the business community wouldn't know about you.
I wrote a golf book also. Back before I had kids, I had another entrepreneurial endeavor back when I was living in Boston. Before I had kids, I partnered with a friend, and we wrote a guide to golf in New England. It's called the New England Golf Guide, and we loved it. It was a great way to be involved in the golf business, and I've met a ton of fun people from that. Got to go to the PGA show in Orlando. It was just fun engaging with the golf world through kind of a business lens.
Fantastic.
That's great. That's great.
Jack Ablin, Cresset Capital, thanks for coming on the show. Once again, on behalf of my colleague here, Mr. Paul Nicolini, myself, JP Maroney, the team at Harbor City, and the Deal Flow Show, we really appreciate you coming on and look forward to seeing what comes from this. As I had mentioned before, we're going to be publishing a book called Deal Makers, Deal Breakers, and sharing a lot of the wisdom that we draw from the show, and we certainly would love to include quotes and information from that. Reach out to Jack at CressetCapital.com, and we'll see you on another episode very soon of The Deal Flow Show. If you want to get access to more episodes, you can go to thedealflowshow.com. Take care, everybody. We'll see you soon.
Thanks, Jack.
For more episodes, visit thedealflowshow.com and subscribe.